we've got Rohit Srivastava, founder and market strategist at indiacharts.com, joining us this morning. Good morning, Rohit. Well, we aren't seeing the kind of crashes that the rest of Asia, especially Japan and South Korea, are seeing today. But another day of pain in store for the Sensex and the Nifty. In fact, Sensex is down about 800 points or so. Is this primarily to do with the spike that we are seeing in the oil prices, given the fact that the Houthis are now entering the active war in West Asia and the alternative route to the Strait of Hormuz, which is the Red Sea, also coming under threat?
Well, that's playing on our minds for sure. And it's happening at a time when the US wants to get on the table and have talks. So it does create a huge diversion in our minds. But here's an interesting fact about Asia, as I was just looking it up, while you were explaining. While there's been a gap down on most Asian markets, and maybe Japan did make a slight lower low, the rest of Asia, Taiwan, China, Korea, Singapore, Indonesia, all these markets have not made a low lower than the ones that they'd made in March. So which means that even while these markets are down, they're not breaking the March lows as yet, except for Japan. So that's an interesting feature. And similarly, then if we compare that to the Indian market, we marginally broke last week's low and are recovering from there. And if we look at our momentum indicators, they're actually starting to turn upwards, which means that the downward momentum is starting to wane. On weekly charts for the last 2 weeks, we sort of closed exactly where we opened, which is also sort of showing the downward momentum slowing down. So that's the first sign of a reversal. While we don't have a complete reversal yet, the first sign is that the downward momentum is waning. So that's a good thing. It probably indicates that the market's hoping for some kind of resolution. While it may not have happened, the Houthis attacks, etc., are good distractions in the short term, but we really need to wait for the end picture. Having said that, seasonally, our markets also tend to be down Jan, Feb, March historically, and we are at the end of that phase. So I would be a little hopeful for at least some kind of up move to show up, whether it is trend or counter trend, into the first 2 weeks of April. So slight optimism in the short term. I don't know whether it will translate into something bigger or not, but at these oversold levels, we would like to look for where there is value, from an investment standpoint.
I want to understand this term being reported in, as far as the U.S. stock markets are concerned, that the U.S. is now officially in what is called the correction territory. Is that one step before what is called the bear market? Are we expecting, because analysts in the U.S., in fact, following the U.S. stocks, are suggesting that this correction could be a lasting correction. Is it fair to assume that the next phase of correction territory is a bear market?
So, sometimes when the markets start breaking down like they were doing in January, what I told a lot of our clients is that prepare for the worst and hope for the best. So that's sort of where that comes from. When you start seeing this kind of a breakdown, we say that, okay, let's prepare, let's hedge, but let's hope that it doesn't happen. So that's the same with the US. Things look bad, but as I was also seeing this morning, that because of a lot of price changes and cost changes, there are actually earnings upgrades in the US, which is making it look like the earnings will improve over the next 2 quarters or 3 quarters. So it's pretty tricky. The hard part is that if you keep oil prices high and you don't resolve this, I think beyond mid-April or end of April, most of the economists have made it pretty clear that you're going to get a recession. So it's very important that we resolve this, in the early part of April, or at least get some signs that it's going towards resolution for that not to happen. But one thing which is become certain is that there are going to be certain shortages, whether it's in chemicals, fertilizers, and various segments of the oil and gas, pipeline or the supply chain, which are not going to come back online quickly. So that will have a secondary rub-off effect for 3 to 6 months to come. It may create some inflation in particular parts of the market. I do see the potential for agro commodity prices to remain elevated during this period. So that could be one source of inflation, which is food inflation. So these are the hidden risks, even if there is a resolution that will, still cause some trouble. But let's not, while we can say that there's a potential for this to roll over into a recession bear market, we are getting to the point where many of the markets are getting very oversold. And any positive news can also create a snapback rally. So I think we'll have time to think about it. And we can come to that conclusion, in the weeks ahead.
All right. And moving domestically now to the banking and financial stocks. And that is another interesting story which has played out since Friday, with the RBI saying that it wants to put that $100 million cap on the net open positions. And many reports out there indicating that this could mean as high as maybe a 4,000 crore rupee loss for banks cumulatively. How strong are those fears, and what does it mean for banking stocks? Because they seem to be in the red. In fact, HDFC, SBI, ICICI Bank, all down more than 1% or so in trade. Let's pull up, in fact, the banking stocks. And you've also got Axis Bank, which is down almost 3%, Kotak Bank, which is down about 2.8%. So, A, explain to our viewers what exactly is this $100 million cap that RBI wants to maintain on net open positions as far as banks are concerned, and B, what their positions on these stocks should be.
So you see, banks have a lot more leeway. Corporates have some leeway. Banks have a lot more leeway when it comes to trading the forex markets. So banks are even allowed to go into the NDF markets and take a position. Corporates also have more, have greater limits than individuals could have. A year back in April, the RBI did away with individual limits, which means we could go on NSE and trade in USD INR futures up to 1 million or so. And then beyond that, you would have to show that you are a producer or an exporter of goods and services. They removed that limit, which means retail can no more participate in the currency futures in India through the NSE unless you are actually doing trade. So that was one step towards currency management. Now they've moved to the next step. They're saying even the banks now beyond 100 million exposure cannot use their limits, which were earlier much more significant. And so what most banks did is they had a trading book on currency, and they could actually go to the NDF is basically the foreign derivatives market, and even take positions there directly for liquidity reasons in different currency pairs outside of the USD INR. So they would do a lot of currency trading. Now the RBI is saying that no, bring that liquidity back home, which essentially means they need to sell dollars, and they would get that cash back in the bank. Now that can have a positive liquidity effect also, because when you sell the dollars, you're getting cash back into the bank's books.
Right.
So that shortage of liquidity which was there, the RBI had to keep doing OMOs. That brings back some money, and the amount is being said around $40 billion worth of dollars over the next week or so need to be squared up or brought back through the banking system. So that's a good amount. It will bring currency stability.
Right.
Even if I look at the charts of USD/INR, they were very, very overbought. So there was a case for us to expect a correction, and the news is sort of
that correction has in fact come in, Rohit. In fact, the INR was trading at levels of almost $95 a barrel, 94.8 or something. This morning they have recovered drastically, and I think that positive correction is now reflecting that INR is trading at about 93.69, which is also extremely high, but relatively lower. It's a correction of about 1.3% or so.
I think it will continue. I mean, this is just day one. They've given time for the unwind. I think probably till the 8th or 9th of April, you'll continue to see that dollar unwind.
Right.
And that will, because 40 billion is a large position. And that kind of selling can bring the USD INR down by a few more rupees, I feel. So that's going to be there. And so, yes, there is some negative impact on banking. But, when we study markets from a news flow perspective, the worst news usually comes at the bottom. So I would usually take this as a one-off hit that, banks will show in the next financial year. And so it may not even be required that they show it immediately.
Right.
But it's good for the currency side, for the macro risk getting off the table, and it does improve liquidity at the bank's end also.
Okay, so there would be liquidity improvement at the end of the banks, and meanwhile you're saying that there could be some sharp reversals as well in the first 2 weeks of April. But if history is anything to go by, and I'm looking at the short history ever since this calendar year started on the 1st of Jan, the kind of negative returns that investors are dealing with are absolutely heartbreaking, one would say, with the Nifty 50 down almost 13%, Nifty oil and gas understandably down more than 11%, but also deep impact seen on the Nifty auto. And even this morning, in fact, auto stocks are down. Mahindra & Mahindra is down about 1% or so. It started much deeper in the red. IT continues to be this bleeding ground for investor wealth. The kind of erosion we are seeing in the IT stocks is absolutely reaching a point where investors are losing all confidence in India's IT story ever recovering. Similar sentiment even across the small cap, mid cap space. So the pointed question really is that investors who are possibly looking at the paycheck hitting their accounts on the 1st of April, if not before, what should they do? Is this the time to continue with those old SIPs that they've been holding on to, or is this the time to actually go after some quality stocks? pause those SIPs, buy those quality stocks and stay invested for some time?
Well, SIPs are for a purpose that you continue to invest over time through ups and downs so that you average out at a better level. And it's also for people who have a smaller income source and are only allocating a certain percentage of that to investing. So it's different from lump sum investing. So when it comes to lump sum investing, of course, January was a good time to hedge, which is what we recommended. But if somebody asks me now at the end of March, should I be getting out? My answer would be no. Let's figure it out first, because you've already had a significant fall. I mean, the bank index, as we were speaking, is down 15% over the last 1 month since the war started. So we've already had a pretty deep cut. And at these levels, yes, you would be looking for bargains, especially where there is value. I mean, just the auto index, for example, while it's down, we can also argue that it's sort of making a triple bottom because it's touched this level of 23,800 the third time, I think, over the last 2 weeks. And so is it really breaking down? Similarly, IT stocks, I'm not a long-term fan of IT stocks, but I can say that the correction in IT stocks looks at the fag end because they're not falling anymore with the market. That's something you can even see in, say, stocks like Reliance Industries. It's not falling any more with the market, meaning it's not making a new low while the markets are making new lows since almost the 4th of March. So these are early signs that, various stocks now don't want to fall anymore. And when that starts happening, then it's not probably the right time now to be selling. That opportunity to sell and get out is gone. What we would do is wait for the markets to stabilize, rebound, and then reassess. The question you asked me in the beginning, is there a recession risk? Is there a bigger bear market risk? I think we have time to reassess that.
Okay.
But there are value plays in certain segments that people can still look at.
All right. So basically what I'm hearing you say, Rohit, is while the government is saying don't panic, buy fuel, you're saying don't panic, sell stocks that you own already and maybe wait for time to tell which side the market direction will actually take. Thank you so much, Rohit, for all your input and for joining us here on News9. Always a pleasure.